Good day, everybody. Brian here, quantlabs.net. Today is the 31st of January, 1638 Eastern Standard Time. My time, New York time, Eastern Daylight. So, if you like what you're about to see, please join us at quantlabs.net/contact right there. Okay, I've shown this a few weeks ago. If you're new, visit quant-labs.net for all of the latest analysis that I've been doing on interactive brokers, ETFs, Forex, and the like. Also make sure you join our Telegram channel, again at quant-labs.net. So let's get to it. Now, I've shown this before, so I'm not going to bother, but one thing I have added is this is an ETF for NASDAQ. Now, I've gone through various assets to show you. This is what I went through on my Oanda. All of these instruments, filtered out which ones look good, which ones don't. Going through the process of running a Python script that I came up, well, that was already out there on the net. I've gone through that a few weeks ago. Again, you may want to go on that website I just mentioned. So here we have, just so you know, it's a good mix of ETFs across different asset classes. Brent crude oil, or just oil as an ETF, Euro, Swedish, pound against the Australian dollar, pound, and the British pound against the Polish, Singapore. We got Euro against New Zealand, India, natural gas, UK 100, or the FTSE, USD against China, Won, USD against Norway, USD against Singapore, USD against Taiwan. Sorry, Thailand. I'm trying to find, this is the best indicator out there, the most reliable, so you know when the markets are turning. This has been spiking, not spiking, but it's been going up over the last 6 weeks or so. This is the gold silver ratio. It's very reliable. I cannot find anything equivalent to it on the ETFs, but still it's a good metric to have in your arsenal. And then we've added Singapore against the Japanese yen. All three USD indices, that's the Russell, the S&P 500, the NASDAQ, and there's a few other ones that looked interesting, was the Platinum and Euro, Polish, Zloty. So in here, this is what came out as the most optimal moving forward. So it will go in, download 4 months of data, and daily data, and then it will run through portfolio optimization technique, and this is what we ended up with. So if I run this as is, now to be honest, I think the days are coming to an end where if you are trying to build up portfolios from, let's say, from various portfolio managers, I think their days are done. This type of analysis is really critical. Like I said, I've gone through this script before, and it's going to use those three. How many assets we got in the optimal? So we have 1, 2, 3, 4, 5, 6, 7. Now, from what I read, among all of the high-end that you don't know industry magazines, websites, I'm not going to reveal them. These are the highest grade hedge fund portfolio managers out there that uses this site out of England. They say everything needs to be uncorrelated, not correlated, uncorrelated. When you look at this portfolio mix, it's got a really good mix. So what we have here is we have oil, Euro against the Swedish dollar, or currencies, British pound against the Australian dollar, Singapore against the Japanese yen. So we have that mix of Asian there. FCG, I'll show you, USD, Thai baht, and then this one, as far as I know, is the NASDAQ 100 ETF. So if I go in here, and let me just show you what's going on with Yahoo Finance as well. This seems to be a really good mix because it's really all over the place, and they're truly not correlated. So I've shown this as well. In this website, I've shown you quant-labs.net. In there, if you look for the Yahoo, you can kind of learn how I'm doing this. So if I go in here and type in, was it QABA, you'll be able to see that this is a First Trust NASDAQ ABA Community Bank Index Fund. This is the representation of NASDAQ in an ETF that I can have access to via Interactive Brokers. The other one, I believe, was a FCG. So FCG now, if you have not heard, it's natural gas is starting to spike, okay? I can show you that here. So again, this is all coming from a wind. I've gone through the process. So here's the NASDAQ. You can see that on a daily basis or 6-hour basis, 1 hour. It's starting to spike. So that's the best index out of the U.S. Okay, right there, pretty good volume. Okay, haven't seen that in a while. You can see here. Let me show you another one. Really, I find that this mix of portfolios is really good. Okay, so let me run it. And as I said, I've got all this source code, well, not source code, but the tutorials to get you to this point. Now, I don't think any portfolio manager will be able to pull this off because they're not programmers, they're not doing the data science stuff, they're not doing the portfolio optimization techniques. They rely on other departments to do their technical analysis, which is not as optimal. So here is your chart of that performance based upon price. Now, I've said this in a webinar back in the day that this is not optimal compared to, you want to build real wealth, you got to do it in the digital asset space. I'm not going to do any videos on that. I mean, it's making a little bit of money, not a lot, but it's doing much better than this. But anyway, let's continue with this process here. So it's going to download all the data from Yahoo and do some number crunching on different types of portfolio optimization. Now, one key factor that in here where I originally started, I used this originally about a week ago, and then I did this one as of today based upon that list I just showed you here, all of these. And what will happen is, depends upon the kind of portfolio you want. Really, it really comes down to your broker. So with your broker, wow, it's really slow. With your broker, you know, being able to short, you can be very limited. So with Interactive Brokers, as far as I know, I'm new to it all, to be honest, at least on the shorting side, is the only thing you can short are if you go out and apply it and borrow stock from somebody else through Interactive Brokers. So in terms of everything else, I do long only. It's probably not the most optimal, but let me just try this again here. Okay, so let me try running another terminal here. Oh, there you go. Okay, so let me try this again. So today's the 31st of January. Now, there's our chart. We don't really care about that. We care about numbers. So here's our returns when you have each one go against each other, or the days. Sorry, so there's an annual covariance matrix built out. Here's some portfolio analysis with volatility and variance. This is a really good mix. I'm pretty happy with it. So to me, the more I do this, the more it seems to work. So here's our variance, which is not very strong. Volatility is fairly low at 30. Expected annual return at 30%. So if things were to play out over the next year, this is what I would expect. Obviously, the documentation and the framework I'm using forewarns on that. Do not rely on that. But here's where it gets interesting. So it does its overall performance now. So what I'm going to do here is I'm going to mark these. Okay, I'm gonna take note of these. So I'm going to bring up another. Yeah, let me do it here. Okay, so what I'm going to do is I'm going to note these, as well as the weightings of these particular instruments. So what really matters is this. As I said, we want to do a long only kind of portfolio with these negative weightings right here on QABA, USD, Thai baht. Everything else is positive. So I'm going to track this Sharpe ratio, annual volatility, and expected return. And I'll do the next one. These are pretty well the same, I found. Doesn't matter what type of analysis it does. And then what it will do is it will bring up some charts of the horizon, efficient frontier. What you're looking for is how steep it is. That's what matters. So here again, it's another type of analysis. But here's where it gets very interesting. This type of analysis, I don't know which one this is, but you can see here the Euro SE Swedish is negative, USD Thai baht, so if I took that out and left that in, let's see what that pulls up here. So this is really helpful because these are just very simple analysis. So this is a fairly steep, efficient frontier. Again, this is just estimating, so it's not obviously accurate. So I've got a choice here. I can either take out the USD Thai baht and the NASDAQ for this analysis, or for better, from what I'm seeing, again, keep this one for the Euro, take out the Euro Swedish because that's a short. Everything else sort of, and the USD Thai baht stays in. So let me try that out, and let me just show you the source code. So what we're looking at here is, I'm not sure which analysis is which. So this one is calculate returns, annualized sample covariance. So this is just a simple covariance. Let's see this one here. Calculates, that's portfolio optimization, sample covariance. So anyways, I got lots of learning here to do. There's different ones. Maximum Sharpe ratio. So each analysis type is different, but if you go into the portfolio, it's called, there's a Pie, or is it? I'll find it here. Now, as I said, I've gone through this already. Right here, this one, Pi Portfolio OPT. So it's Pi Portfolio OPT. Okay, that's the framework I'm using for this. Okay, it's very simple, but let me just go through the options here. So what it's saying is I'll take out this one. So I'll take out NASDAQ and what's the other one here? NASDAQ and USD Thai baht out as negative. And again, this is a long only portfolio because that's kind of, I'm really limited on interactive brokers unless there's a trick I don't know to do shorting and then get a proper basket for better portfolio. So what we're going to do here is I'm going to duplicate this right here, but what I'll do is I will rerun it, but I take out, what was it, Thai baht, these last two. So let's see if it improves the expected Sharp ratio and returns. Okay. So that's for the first portfolio analysis technique. Oops, that's, oh, there you go. There's my crypto returns for today. Yeah, we want this one. Okay, so we're going to rerun this. So we got 5 assets right here. We got oil, Europe, Sweden, pound against the Australian dollar, Singapore against the Japanese yen, and FCG. So we only have 5. Let's see if it changes anything. Now I can obviously fully automate this. So it looks like, yeah, Singapore Japanese yen is the best. Well, it's based upon price anyway, it doesn't matter. Let's see what happens here. Okay, so let's see what's going on. So when I take out those 2 instruments that I just did, annual return definitely goes up. The volatility goes up slightly. What I'll do is I'll run that. Now I'm just testing here, but this process seems to work pretty good. So here we go. So we have an expected annual return of 17 versus 19.8. Sharp ratio, yeah, so it drops. When you take out these 2, the USD Thai baht and the NASDAQ, it does bring down the performance. Yeah, so let's see on the last analysis here how it did. Okay, see here, this is not right obviously. Expected annual return at 89%, Sharp ratio at 2.5%. So there we go. Alright, so there's that. So it doesn't really do a whole lot, but if I go back into the code and try to do, that's the original. So that was the one I just ran. Okay, let's do this. So I'll have a new one. Which ones am I taking out? Okay, remember this is negative. So the only one I'm taking out that's negative is the Euro, Swedish, and the USD Thai baht. So those are 2 negative. Well, let's do that. So we'll take this one out, right? And the USD Thai baht. Let's see if that changes anything. Okay, so that's the original right here. And this is the new set of instruments we'll have. We'll rerun this. Now this is all it is really, is just portfolio optimizing with weights, new weights, to see what kind of expected ratios would be for Sharp and annual return. But again, I can optimize it, and if you ran this regularly, okay, here we go. So, from what I'm seeing here, this is a complete fabrication. But let's see here. Expected annual return at 39% seems better, but our volatility is higher. But let's see, let's run the next one. So here we go. So our expected annual return won't be, oh, actually it is higher. Yeah, 22%, slightly higher with a Sharp ratio, but it's going to have a little more volatility as well. Because without volatility, you need to have some risk there to get to have potential better returns. So that might be a better portfolio to go with. That's pretty steep, actually. Okay, yeah, it's tough to say, but looking at everything, this is the better portfolio. This one I got right here. So that would involve oil, pound against the Australian, Singapore against the Japanese yen, FCG, which was NASDAQ, and FCG. What was FCG again? There we go. First, natural gas. So yeah, maybe that is a better portfolio. We only have 5 weightings. That again, that's short term over the next couple of days, weeks. I don't know. You have to rebalance. Still trying to figure it out because you have to factor in the commissions when you buy and sell when you do your rebalancing. But that's pretty good for now. I mean, you got a U.S. Index. You got 2 commodities that are doing very well, oil and natural gas, and you have 2 very diverse currency pairs: the pound against the Australian, and we have an Asian one with the Singapore dollar against the Japanese yen. That's pretty good. Let me know what you think. Have a good day. I'll be running this again tonight in my webinar. Over and out. Oh, and don't forget. Make sure you get on our email list, quantlabs.net/contact. This is the best way to manage your portfolio. Other than that, thanks for watching. Have a good day.